In this session, we would be continuing with another topic, which is a part of the third chapter. Third chapter, we've already studied the topic or the area on rectification of errors. And further to that, we would be studying bank reconciliation statement, or BRS. Okay, we would be studying bank reconciliation statement, or we would be studying BRS. Now, before we get on with our discussion regarding BRS, let's briefly have a discussion regarding bank account. Now, every business maintains a bank account. Okay, not only businesses, even in fact, us as regular people or regular citizens, we would also prefer to have a bank account. Now, what's the purpose of having a bank account? A bank helps us to facilitate transactions. So, for example, if you want to purchase things online, or if you want to carry out some online transactions, you want to carry out recharge, you want to carry out you want to buy certain items, you want to transfer some money to your friends, all this could be facilitated with the help of a bank account. So bank account helps us to ease, or it helps us, it facilitates us to carry out the carrying out of transactions effectively. That's the reason why we prefer to have a bank account. But the same thing happens with a business as well. Businesses also prefer to have a bank account, and the reason why businesses prefer to have a bank account is because it facilitates, or it helps them to carry out transaction. Now, for a business, for them to carry out transaction, they could carry out transactions with the help of bank account, with the help of checks, with the help of drafts, with the help of fund transfers, NEFT transfers, etc. So there are numerous channels through which they could go about with for carrying out the transaction. Now, the moment a customer opens up a bank account with a bank, the moment you walk into a branch or you walk into a bank, submit the required forms, submit the required documents that are needed to start a bank account, what the bank would immediately do is they would open up a ledger account in your name. What the bank would immediately do is they would open up a ledger in your name. Now, why are they opening up a ledger in your name? The ledger account that is opened in your name facilitates the carrying out of transaction. Okay, so it helps the bank to maintain the transactions. So all the transactions that you are carrying out, it would be recorded against the customer's ledger account. So all the transactions that you are carrying out, it would be recorded against the ledger account. So one important aspect that you have to remember is the moment you walk into a bank, you open up a branch, you open up a bank account, what will happen is it will immediately the bank will immediately open up a ledger account in your name, and the ledger account will facilitate this ledger account will keep a record of all the transactions that you are carrying out. Now, the bank also shares a copy of this particular ledger account with the customer. So, this ledger account that is maintained with the bank and in the name of the customer, the bank will also be sharing a copy of this ledger account. Now, the copy of this ledger account would be shared to the customer in the form of passbook, or it could be shared to them in the form of a statement. So I'm pretty sure those of us who have bank accounts, you may have noticed that the bank from time to time, they would be sending you statements, and the statement covers the details of the transactions that you are carrying out. Now, at the same time, one very important thing that you have to remember is these days, most of the new generation banks, they do not have the concept of maintaining passbooks. They would maintain statement. They would give you statements. So at the time when your parents were transacting or your grandparents were transacting, the bank would be issuing them a passbook. So the passbook is a small booklet that records all the transactions, and periodically, as in when you go and carry out the transactions with the bank would be recording it. Now, one very important aspect that you have to remember is this statement, this copy of the statement or the copy of the passbook, it is the copy of the ledger account which is maintained in your name. So, as a part of accounting compliance, as a part of the accounting process, the bank is maintaining that record. Now, the ledger account that is opened in your name, it is a personal account. If Suku goes to ICICI Bank and opens up a bank account, what ICICI Bank would do is they would open up a personal account in my name, in the name of Suku. Okay, they will be opening up a ledger account in my name, and the transactions that are recorded in that ledger, it is from it is a copy of the transactions that I'm carrying out, and that ledger account is maintained from a bank's point of view. Okay, so remember, the bank would be applying the personal account golden rule: debit the receiver, credit the giver. So debit the receiver, credit the giver. So whenever you deposit money, the bank would be crediting. Whenever you transact on your bank account using your ATM card, using your net banking facility, or using your mobile banking facility, they would be recording that as debits. Why? Because it is a personal ledger account which is maintained in your name from the bank's point of view, from the bank's perspective. So the copy of this would be periodically shared with us, and that is what is called as a passbook or a statement. At the same time, you also have to remember this bank balance. So now the bank balance is already maintained by the bank account. Your bank account's balance is automatically tracked by the bank. They would be keeping a tab of your transactions. They would be keeping a watch of the transactions that you're carrying out, and they would already be recording it. At the same time, the business would also have an accountant, and the accountant would also be making a note or will be keeping a record of the transactions. The accountant in a business, he would also be keeping a record of the transactions that are carried out by the accountant. So you have two sets of bank balances. You have one set of bank balance which is maintained by the accountant in a business, and then you have another bank balance which is maintained by the bank. You have two sets of bank balances. One bank balance is maintained by the accountant in a business, and the other is the bank balance which is maintained by the bank. So you have two sets of bank balances which are maintained. So one is the bank balance which is maintained by the accountant in the business, and the other is the bank balance which is maintained by the bank. Now, sometimes there could be disagreement between these two balances. There could be room for disagreement between these two balances. Now, why is there disagreement between the balances? So let me give you an example. When we issue a check, you as a business, when you issue a check to your customer or to your vendor, your accountant would be considering that the money has already gone out from your bank account. When you issue a check for your supplier or for your vendor, what we are assuming is that the cash has already gone out from the bank account. So what happens is we would immediately be recording into our bank balance that the money has already gone out. But in reality, that is not what happens. When you issue a check to a supplier or to an accountant or to a vendor, the vendor will collect the check from you. He will visit the bank, and then he will be then submitting the money into the depositing the check into the bank, and that is when the money will be leaving the bank account. So when you issue a check to a vendor or a supplier, it is not necessary that the money would be going out from your bank account immediately. What will happen is the supplier or the vendor will have to take the check, go to the bank, deposit the check, and only when the bank clears the check is that the money would be going out from the bank account. So let me give an example. You had a supplier, you wrote him a check. Now, what your accountant would do is he would immediately take a record and say the money has gone out from the bank account. But the supplier to whom you gave the check, what he did was he took the check and he deposited the check only after a month's time. So the money would be going out from your bank account only after a month. But in your cash book, you have a record that says that the money has already gone. So these are some examples, these are some scenarios where there could be a disagreement between the bank balance as per passbook and the bank balance as per cash book. So, what is reconciliation statement? Reconciliation is a statement that is prepared to reconcile, to compare the bank balance as per cash book with the bank balance as per passbook. So, it's a statement that is prepared to reconcile the bank balance as per cash book with the bank balance as per passbook. So, why do we prepare the BRS? BRS is prepared to identify the reasons of difference between the bank passbook balance with the cash book balance. Okay, we are preparing this to identify the reasons of difference between these two balances. Now, at what frequency can you prepare the BRS? BRS is prepared at regular intervals. So you could prepare it on a weekly basis, fortnight, or a monthly basis. So depending on the frequency that you desire, you could go about with the preparation of the BRS. Now, what are the scenarios where you could have a difference? So one would be there is an interest credit made by the bank. So whenever the bank credits interest into your bank account, it is not necessary that it will be reflecting in your passbook, but it need not reflect in your cash book. Why? Because it is not something which is coming to the notice of the accountant. Or another scenario is where the bank is charging you some amount of money as charges for operating the bank account. There could be reasons of difference. So these are some of the examples where there could be reasons of difference between the bank balance as per passbook with the bank balance as per cash book. So the statement that is prepared to compare these two bank balances is what is called as the BRS. Now we would be focusing on the preparation of the BRS, and I would be focusing on a shortcut method for you. So what I have done over here is I have classified the possible transactions that you can get as a part of BRS, and I've classified them into two sets. So there are 14 transactions that you will have to learn, and these 14 transactions I have classified them into two categories, set 1 and set 2. So if you can understand which set does these transactions fall into, it will help you to prepare the BRS a lot easily. Okay, so for example, check issued but not presented. Okay, so for example, you have given a check to someone, but that person has not given that check for payment. Okay, so in such cases, those transactions will fall under set 1. Or for example, check deposited but not yet cleared. You got a check from someone, you deposited the check into your bank account, it has not been cleared as yet, it has not been collected as yet. In such cases, it will fall under set 2. So like this, under each set, that is set 1 and set 2, we have around 14, we have around 7 transactions each, which makes it a total of 14 transactions. And if you can learn these 14 transactions, then preparation of the BRS will become very easy for you. So instead of focusing on the hand rule, the conventional hand rule of preparing BRS, if you focus on these 14 transactions, it will be very easy for you guys to go about with the preparation of the BRS. With that note, there's one more important thing that you will have to focus over here on. Now, there is a thumb rule that you guys do have to remember. Now, there are 4 possible scenarios that you can get with respect to preparation of BRS. There are 4 possible scenarios that you can get. The first is you're given balance as per cash book. You will have to find out balance as per passbook. Or you're given balance as per passbook, you will have to calculate balance as per cash book. Okay, So if you're given this scenario, that is, you're given balance as per cash book, then all transactions that fall under set 1, you will add. All the transactions that fall under set 2, you will subtract. You will automatically get the balance as per passbook. Next is, if you know the balance as per passbook, and you have to calculate balance as per cash book, add all the transactions in set 2, subtract all the transactions in set 1, you will get this. So similarly, if you're given overdraft, then this is what you guys will have to do. So if you can remember this thumb rule, then preparation of BRS is a very easy work. Okay, preparation of BRS is a very easy work. So with that, I've given you an understanding about what is BRS. I've also taught you the shortcut method with regards to the preparation of BRS. Now we will be focusing on the numericals.